Coca-Cola posted mixed earnings results for its fourth quarter. The beverage company missed on revenue estimates, but slightly beat on profit and set modest expectations for growth this year. To get reaction to that, we're joined by Peter Grom, equity research analyst at UBS. And Peter, thanks as always for joining us.
Thank you so much for having me.
Okay, initial reaction to the report.
Look, I think the stock reaction kind of makes sense to me for three different reasons. One, as your prior guest alluded to, I think there was some great expectations around Coca-Cola. It has been one of the best performing consumer staple stocks for not only this year, but for the last, call it 12 to 18 months. And so, valuation was already stretched for Coca-Cola heading into today. Second, I would say the quality of the earnings print, you alluded to the revenue miss. Organic sales came in marginally ahead of street expectations, but the composition of that was a little bit mixed. There was a unit case volume was a little bit more challenged, and price mix came in a little bit below expectations. And I think the last, and maybe most importantly, it really comes down to the guidance, right? I think the company delivered 5% organic sales growth this year. They're kind of guiding to 4 to 5%, which would imply a bit of a slowdown as you look out to 2026. And then I think on the earnings front, I think people were expecting better underlying expectations. Specifically, the 7 to 8% total company EPS growth would more or less suggest street numbers don't really need to change all that much. But I think the company outlined 5 to 6% underlying growth, which is a little bit below what we've seen historically. It's below the company's long-term, historical averages. So I think, at the end of the day, it's not a bad print by any stretch, but I think it's just a combination of the print and the outlook being a little bit below expectations and valuation being ahead of itself a little bit into today.
And it faces some pretty serious challenges right now, doesn't it?
Yeah, across the board, and like many other consumer staples companies, but yeah, it's across the board.
What's the biggest concern for you? Is it the people turning away from sugary? I mean, so many people go into weight loss drugs now, and they're starting to stay away from it. That's a challenge to try and sell sugary drinks, and I know that's not their only market, but that's a big part of it. Is that their biggest challenge, or trying to get? They were excluded from food. What do you call it down in the States?
The SAP, yeah.
Yeah, the SAP. Is that a big? What's the biggest challenge for them?
Yeah, I mean, from a business perspective, there's two things, right? There's the stock perspective, right, and I think there's the business standpoint. I think from the business perspective, right, I think the GLP-1 headlines are very important, and they're a big important topic of conversation, I would say. But for a company like Coca-Cola, right, that they're very global. Right. And so you have to think about this GLP-1 dynamic, is really more of a developed market, more of a U.S. narrative. So they're not going to be as impacted as maybe some of the other staples peers, on a total company level. And then when you think about beverages, right, I mean, yes, soda, sugary beverages, it's kind of the poster child for GLP-1 in some ways. But you have to remember they have zero sugar offerings, they have diet offerings, and they have a lot of other products, in water and juices and protein drinks that are going to be more on trend with it. So I think at the end of the day, it's just, I don't want to say that they don't have an issue as it relates to kind of top line growth, but I think they're probably going to see more durable growth over the next 12 to 18 months versus much of the rest of the group. I think from the stock standpoint, it's a little bit different, right? I think what you're seeing, or what you've seen over the last, call it 2 years, is there's been a very few names that have worked in consumer staples, and Coke has been one of them. And so what you're starting to see across the space is what I would call a broadening of growth, this rate of change narrative taking hold, where things are going from bad to less bad, some going from bad to some cases good. And I think as that happens, you're seeing greater interest in other pockets of staples, maybe where there's more room for relative multiple expansion. And I think that's kind of been more of the challenge for Coke as you think about it relative to other staples peers.
And now Henrik Braun is coming in as the new CEO. I mean, he's been with the company for, I think, 30 years, pretty much worked through it all. How is he being received, and where do you see him taking it? Do you see him doing anything extreme, or just kind of nudging the ship along?
I think it's more nudging the ship along, right? I think James Quincy has done a phenomenal job in his tenure as Coke CEO, right? I think they've a decade ago, there was debate around, whether Coke could ever deliver on their long-term organic sales target, EPS targets. They had kind of installed that at a $2 earnings per share number for a really long time. And he really kind of, righted the ship. And they've done a tremendous job in terms of delivering, stronger top and bottom line growth. So obviously you can't rule anything out. Every new CEO wants to have their own, their own take on the business, but I would not imagine or expect any major changes on the horizon here.
Okay, and we touched briefly on international markets. China, how are they doing with China? They're struggling a little bit, right?
They had a more challenging quarter than maybe what we've seen historically. It was a little bit of a weaker exit rate. I don't know that I would say that's unique to Coca-Cola. I think you're kind of seeing that in a lot of other pockets of staples companies, with maybe the exception of beauty.
All right, Peter, we'll wrap it up there, but thank you as always for joining us.
No, thank you so much for having me.
Peter Grom is equity research analyst at UBS.